The years 2021 and 2022 were all about surging inflation due to the double global inflation shock of COVID supply constraints and then the invasion of Ukraine by Russia. We believe this year will be different, and inflation is set to fall notably, reversing perhaps the majority of the surge over 2021-22. So the heavy lifting by global central banks of tightening monetary policy through raising nominal interest rates is nearly behind us. But monetary policy tightening is set to persist through two channels. Firstly, as inflation falls, policy rates in real terms will continue to rise. And secondly, central banks' balance sheets will see an accelerated and broader decline as we move from QE to QT. We estimate that QT in 2023 across G10 will result in over $3 trillion of shrinkage in global liquidity, with much of this total coming from just the Fed and the ECB. For the Fed this year, this is quite straightforward, given 98% of its balance sheet relates to securities held. So US Treasury bonds and MBS will be reduced by $1.14 trillion this year. For the ECB, its balance sheet is more diverse, with APP and PEP accounting for 60% of total assets, and TLTRO funds another 17%. If all APP securities are allowed to roll off the balance sheet between July and December, and all TLTRO funds are paid back this year, that would result in a €1.6 trillion shrinkage in the ECB's balance sheet this year. So what are the implications for FX? Firstly, policy rate deliberations are likely to remain the dominant influence on FX this year. However, the end of negative rates and the scale of liquidity being removed is already impacting longer-term rates. Since 2014-15, when the ECB introduced negative rates in QE, the 10-year US Treasury bond spread over bunds has been north of 150 basis points most of the time, with flow data indicating sustained selling of Eurozone bonds by foreign investors. That spread is now at 135 basis points, and if maintained, is consistent with a higher euro-dollar. Other factors like risk developments, energy prices in Europe in particular, relative growth outlooks, will mean continued FX volatility. But for euro-dollar specifically, these factors point to a higher euro-dollar this year.
There's three key areas that we should focus on. Let's start with the US economy. 2022 was a year that was plagued with high inflation, uncertainty at the beginning of the year if we were truly in a recession or not in a recession. Growth was relatively timid, but the labor market remained resilient. The fact that that was happening in many ways suggests that we don't have a recession, and perhaps we can actually have a soft landing. But our view is that this is a year where we're going to likely pass the baton from inflation concerns to growth concerns, because many of the leading indicators that we track, like ISMs and PMIs, LEI indicators, are all suggesting, as well as the yield curve, are suggesting that perhaps we are at the precipice of a recession. Turning to the Fed, which was very aggressive last year with monetary policy, they're aiming to likely push rates into the 5% level or higher to try to continue to combat this elevated inflation. Meanwhile, they're also doing a process known as quantitative tightening, known as QT in the marketplace, where they're also draining liquidity from the system. Those two forces at play are trying to impact financial conditions and ultimately aggregate demand to slow down the economy and try to arrest inflation. Finally, turning to the markets, after years of low rates, we're seeing rates rise globally. First in the US, now in Europe, and even in Japan, which has had historically low rates, has seen a rise in rates. What's the significance of this? Well, perhaps we're going to see a changing of behavior from investors that will prefer to buy their local bonds at higher rates versus shifting capital to the US, which has been a recipient for foreign flow for many years. The U.S. bond markets in general had a very difficult 2022, one of the worst performing years in history. That was also true for the credit markets, but they were largely impacted by the higher rates. If rates remain elevated, both in the U.S. and globally, it's quite possible that the credit markets, even after a rough year, may have another rough year. So our view is that we think that the credit markets haven't properly discounted the lags effect of the higher rates and also the potential upcoming recession if we do indeed fall into one. Those forces, I think, are not priced in properly into the credit markets. Meanwhile, you have a government bond market that has a yield curve that's inverted. These things are inconsistent. A very kind of robust credit market and a bond market from the sovereign side saying that we're heading towards a recession. We think that ultimately the government bond market will be proven right. It might be too early. Meanwhile, credit is overvalued as it starts off the year.
The Chinese economy delivered a 3% growth for 2022, far below the target of around 5.5% set in the beginning of last year. The strictly enforced zero-COVID policy and a mood of uncertainty during most of the year were the main reasons for the weak domestic demand and supply, even with the proactive fiscal expansion and loose monetary policy in the year. Recently, the Chinese government abandoned its tough COVID policy. However, the challenges still remain in the near term. COVID infections stay high and are climbing in some areas of China due to the country's inadequate vaccination rate, particularly for the elderly. It is estimated that the peak of the epidemic may come within 1 month, and it may take several months more to get through the epidemic as a whole. Under that assumption, proactive fiscal and quasi-fiscal policies, as well as various property policies, will eventually help to build up confidence among consumers and entrepreneurs. We expect the Chinese economy to pick up speed in Q2 and Q3 and return to a sustainable recovery path in Q4. We see a 5.1% growth for 2023 after a 3% growth in 2022. China's relatively better economic performance would also help boost market sentiment towards Chinese assets, including the nation's currency.
Notwithstanding the largest energy supply shock since the 1970s, the year 2022 was one of admiration. Europe, as the epicenter of global volatility, displayed characteristic unity, tenacity, and a principled willingness to bear unprecedented economic costs in response to the war in Ukraine. A confluence of weaker demand, milder than usual weather, and tepid Chinese LNG imports, given its zero-COVID policy, has meant that Europe's previously assumed winter of discontent has been by and large content. Yet the crisis is far from over. We classify the year 2023 as one of alarm. Whilst the U.S. natural gas market remains comfortable on benign production and weaker power demand, it's across the pond where our concerns lie. The precipitous decline in European natural gas prices since last summer has created a false sense of security. The collapse in Russian flows, rising Chinese demand for LNG, and ongoing demand defense measures will reinforce the tightness in European gas markets and support prices. Meanwhile, the supply side of the oil market remains constrained. Inventories are at multi-year lows, spare capacity is thin, and a structural underinvestment in oil, as well as the broader commodities complex that predate the war in Ukraine, remain unresolved. The most alarming issue for 2023, in our view, is the continued spread of European deindustrialization risks. Not only is the speed of permanent industrial asset closures gathering momentum, given unsustainably high unit energy costs, but Europe is now having to compete on two fronts. Firstly, the promising U.S. Inflation Reduction Act that aims to promote the Made in America Renaissance, centered on renewable capex investments. And secondly, the longer history of cost-competitive factory Asia. There are growing apprehensions that the recasting of the global energy system will pose a test of Europe's business model in 2023 and beyond.
Well, last year was another very difficult year for emerging market currencies. Our MUFG, Emerging Market FX Index, declined by about 6%, and that was the fifth consecutive year of calendar losses, taking cumulative losses over that period to almost 20%. So we have seen a sustained period of emerging market weakness. However, if we look at recent price action over the last couple of months, we are starting to see a turn in a more favourable direction for emerging market currencies. There have been two fundamental reasons why investor sentiment towards emerging markets is starting to improve. Firstly, developments in China are moving in a more positive direction. Policymakers there have made the decision to shift away from their zero COVID policy stance. And while that will lead to some economic disruption in the short term, once we get past the peak of the current COVID wave, we expect China's economy to reopen more fully and demand to bounce back more strongly in the second half of this year. And we think that's going to provide a positive tailwind for Asian currency performance. And on top of that, emerging market currencies which are tightly linked to China demand, such as LATAM currencies in Brazil and Mexico, should also outperform in that environment. And the second fundamental reason, which is becoming less negative for emerging market currencies, is the ongoing shift in Fed policy. At the last Fed meeting, the Fed delivered a smaller rate hike, a 50 basis point hike. And we do think that the direction of travel is towards the Fed bringing an end to their rate hike cycle in the first half of this year, which we believe will provide further relief for emerging market investors and help to lift emerging market currencies.